Welcome back to the deep dive. Today, we're really getting into something foundational. We're looking at the blueprint, the core secrets and rules used by champion stock traders for achieving what our source material calls super performance.
That's right. And it's not just about picking winners. It's much deeper. We're distilling the mental framework and the actual mechanics you need to really shorten that learning curve.
Yeah, cutting through the noise.
Exactly. Focusing on how you can get those big returns, but crucially, with controlled risk. We'll be digging into planning, risk management, self-analysis, entry strategies, basically sections 1 through 7 of the material.
And the core message seems to be, that success isn't luck. It's actually a choice. We're aiming to unpack the specific knowledge and discipline needed to make that choice effectively.
And it all starts with what the material calls the crucial prerequisite, the champion mindset.
Which means?
Taking 100% responsibility for your trading results. No excuses. Because if you blame the market, your broker, anything external,
You give away your power to fix it.
precisely. 100% responsibility gives you 100% ability to respond, to adapt, to change what's not working.
Okay, let's unpack that a bit more because, well, the material suggests everyone has this potential champion inside them. So if that's true, what stops most people? Why do so many traders struggle? What's that internal conflict?
It's that classic internal battle, isn't it? The source uses the tale of two wolves analogy. You've got two forces inside you.
Okay, so the first one is the internal builder.
Right. The builder is your discipline side. It's process-driven, focused on executing the plan correctly. And importantly, it sees mistakes not as, failures, but as feedback, data points.
Teachers, essentially.
Exactly. Valuable teachers.
Yeah.
The builder knows results come from the process, so the focus is always on refining that process.
And the other wolf, the saboteur, the wrecking ball.
Yeah, the wrecking ball. That's the impulsive, emotional side. It gets a thrill from the gamble, loves the excitement. But when things go wrong, it looks for excuses, blames external factors.
The material suggests sometimes people feed this wrecking ball because subconsciously they need that drama, that destructive cycle.
It sounds counterintuitive, but yeah, that defective need to feel alive, as the champion puts it. It can manifest as taking tiny profits but letting losses run wild, creating that emotional roller coaster.
Okay, so how does this internal fight, this builder versus wrecking ball thing, specifically mess with the goal of actually making money in trading?
It comes down to belief alignment, or misalignment, rather. Let's say deep down, you truly believe that to make big money, you have to take big risks, swing for the fences, endure those gut-wrenching drawdowns.
Right, that's a common belief.
Well, if that's your core belief, you're almost guaranteed to sabotage a strategy that relies on low risk and high reward. You might start with a tight 7% stop loss.
But then that inner voice starts whispering, nah, this stock needs more room, give it 20%.
Exactly. You create this internal conflict. For success, you need congruency. Your actions, like setting that tight stop, have to align with a core belief that, yes, you can achieve fantastic returns without taking massive risks.
That makes sense. You have to genuinely believe the low-risk approach works.
And getting there, achieving that alignment, it often means getting uncomfortable. It requires pushing beyond your comfort zone, like an Olympic athlete training relentlessly, or a doctor during residency. Total immersion.
Which brings us to that principle, the CLUM principle.
Yeah, CLUM. Comfortable equals less. Uncomfortable equals more. Progress, real progress, means consistently doing the things that feel unnatural at first.
Like taking a small loss quickly instead of hoping.
Exactly. Or waiting patiently for days, even weeks, for the perfect setup instead of jumping in out of boredom. Or, meticulously journaling every single trade, even the embarrassing ones.
The comfortable path is buying familiar names, holding losers.
And that guarantees less success. Mastery means choosing the uncomfortable path again and again. That's how you shorten the learning curve. If you're not willing to do the hard mental and mechanical work, well, you can't really be surprised when you don't get the results.
It's like showing up to court expecting to win a huge case after just glancing at a couple of law articles. You need to internalize the knowledge, live the discipline. Okay, let's shift gears to the mechanics, the actual blueprint. Section 1. Always go in with a plan. Seems obvious, right?
Uh.
But the source argues this is a massive failing for most amateurs.
Oh, it's kind of amazing, isn't it? How little prep folks do when real money's on the line. I mean, trading is serious business. It's like performing surgery or designing a bridge.
Yeah, you wouldn't wing those.
Exactly. Yet the champion points out, people will spend hours researching an $800 TV, but then throw $100,000 at a stock with barely a second thought. That lack of respect for your own capital is just deadly.
And often the only plan they have is that vague, often misused idea, buy low and sell high.
Right. And applying that simplistically to individual stocks is just dangerous. Amateurs think, oh, this blue chip is way down, must be safe to buy now. But history screams otherwise. Think about GE.
General Electric, yeah. What happened there?
Well, after it peaked back in 2000, it just cratered, fell over 90% over the next several years. And even 16 years after that peak, if you'd bought it thinking it was cheap somewhere along the way, you could still be down 50%.
Wow. So much for safe.
Just hammers home the point. There's really no such thing as a safe stock. They're all risky, especially the ones that look cheap after a big fall.
Okay, so if all stocks are risky, the plan becomes paramount. What absolutely has to be in that trading plan before you hit the buy button?
4 non-negotiables. First, your exact entry mechanism, the price, the signal, whatever triggers the buy. Second, your risk management, the absolute hard stop-loss price. No ambiguity.
Got it. Entry, stop loss.
Yeah.
What else?
Third, your profit-locking criteria. How and when are you going to take profits? Scale out, trail stops. And fourth, position sizing and reallocation. How much capital are you committing, and how does it fit into your overall portfolio risk?
Now, here's where, for me, it gets really interesting. The source identifies the biggest enemy of sticking to the plan. It's hope.
Hope. Yes, hope is absolutely not a strategy.
Why is it so dangerous here?
Because hope makes you rationalize inaction when you should be acting. Stock drops 8% past your planned exit. Hope whispers, oh, it'll bounce back. Stock's up 15%. Hope screams, it's going to 50%. Don't sell yet, even if warning signs appear.
So the plan removes the need for hope.
Exactly. It sets clear, objective expectations beforehand. The champion uses that great analogy of a train schedule.
Right. The train. Explain that.
Okay, so if your train is scheduled for 6.05 and it shows up at 6.15, fine. Minor delay, still on track, basically. Your plan should allow for that kind of minor wiggle room. But if it's 7.30 and the train still hasn't arrived...
Something's seriously wrong. Time for plan B.
Precisely. You know the underlying situation has fundamentally changed and you need to exit, find alternative transport. The plan tells you if the trade is running on time or if the premise is broken and you need to get out.
Which means you need contingency planning baked in from the start. Professionals are prepared for almost anything.
Absolutely. You need to predefine your responses, not just the initial stop, but okay, if I get stopped out, under what specific conditions would I re-enter? How do I decide whether to sell into strength or wait for weakness? And, crucially, what's my disaster plan? Power outage? Internet down? Do I have a backup broker?
Thinking through the what-ifs beforehand.
Yes. But maybe the most vital contingency is protecting profits once a trade starts working.
Right, locking in those gains so they don't vanish.
That's where dynamic stops come in. Once a stock moves up, say a multiple of your initial risk, maybe it's up 20% and you risk 7%, you must move that stop up, often to break even, maybe higher using a trailing stop.
Even if it feels like you might be cutting a winner short.
Look, feeling a bit foolish, taking a small profit or breaking even is nothing compared to the psychological gut punch of watching a 20% gain turn into a 7% loss because you didn't adjust. That erodes capital and confidence. The plan has to evolve with the trade.
Okay, so the trade is on. Now the plan dictates how we interpret the immediate price action. The source uses that simple visual. Is the stock acting like a tennis ball or an egg?
I love that visual too. It's so clear. You buy the stock as it breaks out of its base. What happens right after?
Tennis ball behavior means?
It means pullbacks are short and shallow, maybe 2 to 14 days max. And crucially, those pullbacks are met with strong buying. The stock bounces back quickly, pushes to new highs, often on heavier volume than the pullback volume.
Like the examples in the material, Netflix or Green Plains back in the day. It's resilient. It bounces.
That's the tennis ball, healthy action. It signals institutions are likely still buying, absorbing the selling.
But if it pulls back, maybe even dips below the breakout point and just stays down, fails to rebound.
That's the egg, splat. It shows a lack of demand, maybe early sellers, overwhelming buyers. You have to watch that immediate follow-through action very closely.
Using the follow-through count.
Right. In the first week or two after the breakout, you want to see more up days than down days, ideally maybe 6, 7, 8 days where it moves higher. And you want more good closes closing in the upper half of the daily range.
Why are those good closes so important?
They show persistent demand throughout the day. Buyers are stepping up and holding the gains into the close. It's another sign of institutional accumulation, building those large positions they can't fill in just one go.
Okay, strong follow-through, good closes, tennis ball action. Signs the big money's still coming in. But here's a tricky one. What about stocks that blast off immediately? They jump 10%, 15% right out of the gate looking really extended. Isn't that the time to sell?
The don't chase dilemma. This is where David Ryan's observation is so critical. He noticed that often these stocks that get extended quickly just keep going. Why?
Because the institutions still aren't done buying.
Exactly. The big players, the ants, as the source calls them, might need weeks to build their full position. So a stock looking extended might just be starting its real move. You need a way to tell the difference. That's the MVP indicator.
Break that down for us.
MVP stands for momentum, volume, and price. You'd consider holding an extended position if it shows. First, strong momentum. Maybe it's up 12 out of the last 15 trading days.
Wait, 12 out of 15 days. Seriously, that sounds incredibly strong, almost too strong. Ripe for a pullback? No.
It sounds that way, but think about how it's moving. If it's methodical, consistently grinding higher day after day, that's not usually retail frenzy. That's often institutions systematically buying, maybe using algorithms or multiple brokers to mask their accumulation. It's hard to buy, which is bullish, so high momentum is key.
Okay, M is momentum, V and P.
V is volume. You want to see volume generally increasing over that same 15-day period, maybe up 25% or more. Confirms the buying pressure, and P is price strength. The stock should be up significantly, say 20% or more, during those 15 days.
So if all three, momentum, volume, price, are firing like that, even if it looks extended, the message is the big money probably isn't finished.
That's the idea. You're potentially riding a powerful institutional wave. If it's just volatile, erratic price spikes without that consistent MVP footprint, then yeah, that's likely just chasing and riskier.
Makes sense. Now, flip side. What are the immediate red flags? The violations that tell you a trade is failing, maybe even before the stop loss gets hit.
Right, because negative signs often cluster together. You don't usually just get one bad signal. Key violations to watch for immediately after a breakout include a breakout on low volume that then reverses back into the base on high volume.
The quote from Dan Zanger comes to mind. Winning horses don't back up into the gate.
Perfect analogy. If it retreats quickly on big volume, that's institutions saying, oops, mistake, and dumping their initial shares. Big warning sign.
What other price action screams, get out?
Seeing maybe 3 or 4 consecutive lower lows without any real bounce or support kicking in. More bad closes than good closes, meaning intraday rallies consistently get sold off by the end of the day. And a big one, closing below key moving averages like the 20-day or especially the 50-day, particularly if it happens on a heavy volume.
So if you see a cluster of these violations,
you don't necessarily wait for the original stop. The tape is telling you something's wrong now. Time to reduce the position or exit completely. Trust the price action over your hopes for the trade.
But there's that one exception, right? The squat and the reversal recovery.
Yeah, sometimes the stock breaks out, looks good, but then pulls back sharply intraday, closing well off its high. That's a squat. It looks weak. Now, if the overall market is strong, acting healthy.
Only if the market backdrop is good.
Right. You might give it a little leeway, maybe 1 to 10 days, to see if it can stage a reversal recovery, shake off that pullback, and power back up. It's an accommodation to avoid getting whipsawed out by noise in a generally strong environment. But if the market's weak, forget it. A squat is usually just a prelude to failure then.
Okay, let's transition. This next part feels really central. The source hammers on these 2 words. Respect risk. We're into section 2. Approach every trade risk first. And it starts with a pretty stark warning. You have the capacity to do serious damage to yourself today.
Yeah, that's meant to be a bit of a jolt, isn't it? It's the psychological grounding needed to fight our own worst impulses, that wrecking ball wolf we talked about.
Yeah.
Before you even dream about the potential profit, you have to acknowledge your own capacity for, well, messing up. Laziness, lack of discipline, failing to prepare.
And the first step in respecting risk is knowing your exact exit price before you buy. Why is defining the risk so much more critical than fantasizing about the reward?
Simple. If you lose all your capital, you're out of the game. Game over. Potential reward becomes irrelevant. If you enter a trade without that predefined concrete stop loss,
You're relying on a mental stop.
which is basically worthless. As soon as the stock drops, that mental stop becomes flexible. You start rationalizing, oh, it's just a dip, or maybe I'll just wait till it gets back to break even.
And that leads straight to the dreaded emotional stop loss.
Exactly. The emotional stop is that point where the pain, financial, psychological, usually both, just becomes unbearable, and you finally capitulate and sell. But for most people, that point is way, way past where the math made sense. Maybe down 30%, 40%, even more.
That's how you become an involuntary investor.
Yeah, Jesse Livermore's term. You start as a trader, feeling smart when it goes up. But when it goes down, suddenly you're a long-term investor, just hoping it comes back. It leads to that awful pattern. Tiny profits and huge, devastating losses.
And the math behind why those large losses are so devastating is brutal. The geometry of loss?
It really is. Losses work against you geometrically, making recovery exponentially harder. This is why the champion insists on a maximum loss of maybe 10%, but ideally your average loss is much smaller, like 5–7%. Let's run the numbers. They're stark.
Yeah, let's make it concrete.
Okay, start with $10,000. You take a 10% loss. Not great, but okay. You're down to $9,000. To get back to $10,000, you need to make $1,000 on that $9,000. That's an 11% gain. Doable.
Okay.
But let's say you let that loss run to 50%. Now you're down to $5,000. To get back to your starting $10,000, you need to make $5,000 on your remaining $5,000.
You have to double your money. A 100% gain just to break even.
Exactly. Suddenly, it's a monumental task. And if you somehow let it drop 90%, you're down to $1,000. You need to make $9,000 on that $1,000.
Wow, a 900% gain just to get back to zero.
It's practically impossible. That math just screams why controlling losses isn't just important, it's everything. Defense is your best offense.
Which also means avoiding those super volatile stocks, the bucking broncos,
right?
The ones that require really wide stops just to handle the noise.
Absolutely. If a stock is so wild that you feel you need a 15% or 20% stop just to avoid getting shaken out, it's probably the wrong stock for this kind of controlled risk approach. Even if you think it might eventually go higher, the risk you have to take to play is just mathematically unsound for achieving consistent positive results. Find a calmer horse.
That leads perfectly into section 3. Never risk more than you expect to gain. This really brings the math and probability into focus. So if I'm disciplined and always cut my losses at, say, 10% maximum, am I guaranteed to win long term?
Not necessarily. That's only half the equation. You have to look at the other side. What's your average gain? You need a positive ratio between your gains and losses, factoring in how often you're right.
The batting average.
Right. Let's say you do cap losses at 10%, but your average winner is only 5%. Think about that. You'd need to be right almost 70% of the time, nearly 7 out of 10 trades, just to break even.
Which is, not realistic long term for anyone.
Exactly. So your risk control has to support your realistic win probability. The goal, ideally, is to structure things so you can still be profitable even if you're wrong more often than you're right.
Profitable even with a low batting average. How?
By making sure your average winner is significantly larger than your average loser. For example, if you risk 5% on average, but your average gain is 10% or more. Now, even if you're only right, say, 40% of the time, you can still come out ahead. You've built failure tolerance into the system.
That's such a critical point. You control the loss side tightly so you can survive streaks of being wrong, knowing the winners will eventually take care of the results. This is that expectancy idea.
That's the mathematical core of it, yes. Expectancy is basically your win rate, your average gain, your loss rate, your average loss. You need to manage those variables, especially the average loss, to keep that overall expectancy positive over hundreds of trades. That's the edge.
Okay, this really flies in the face of some common advice, particularly around volatility. Many traders learn to widen their stops when a stock is volatile, maybe using something like ATR, average true range.
Right.
Why does this champion blueprint say, no, don't do that, especially in tough markets?
Because widening stops based on volatility when the market is already choppy or weak is often compounding your risk precisely when you should be reducing it. High volatility in a bad market usually means more risk, more danger, not less.
So if your win rate is likely dropping because the market's tough and your average gain is shrinking,
then increasing your average loss by widening stops just crushes your expectancy even faster. You're essentially betting bigger when your odds are getting worse.
So the counterintuitive but smarter move in difficult markets is
tighten up, cut losses even quicker, maybe 5–6% instead of 7–8%. And be content with smaller winners, take profits at 10–12% instead of aiming for 15–20% or more.
play defense.
Protect capital, protect confidence, wait for better conditions. Exactly, which ties into setting realistic expectations based on your actual results, not just wishful thinking. That's the RBA model.
RBA versus TBA. Explain that distinction.
Okay, TBA is the theoretical base assumption. That's where you look at a chart and say, wow, this stock could theoretically go up 50%, and you base your risk on that potential upside.
The dream scenario.
Right. The problem is it ignores your actual track record. Can you consistently capture those 50% moves? Probably not. It's hope-based.
Whereas RBA.
RBA is the result-based assumption. It forces brutal honesty. You look at your trading journal, at your actual closed trades over the last 50 or 100 trades.
Yeah.
What's your real average gain? What's your real batting average?
And you base your risk on that reality.
Precisely. If your data shows your average winner is only 10% and you're right 50% of the time, then RBA tells you, mathematically, you cannot afford to risk more than maybe 5% per trade if you want positive expectancy. Your proven results dictate your allowable risk.
As you get better, your RBA might allow more risk. If you hit a slump, RBA forces you to tighten up.
It's a dynamic feedback loop based on your actual performance. Now, within that framework, there are techniques to manage risk on the position level, like staggered stops.
How do those work?
Instead of one hard stop for the whole position, you might set different stops for portions. Say, sell 1/3 if it drops 3%, another third at 5%, and the final third at 8%. Your overall dollar risk might still be capped at, say, 5% of the position value, but it gives the trade a bit more room to wriggle without stopping you out completely on a quick dip.
Smooths out the noise a bit. And the other technique, pyramiding or add and reduce,
Yeah.
that sounds like adding to winners.
It is, but the key is how you do it to control risk. Let's say you start with 1,000 shares at $16.50, maybe risking $1 a share, so $1,000 at risk. The stock moves up nicely.
Okay.
Now, if you can raise the stop loss on that entire initial 1,000 shares up to your entry price of $16.50.
You've effectively removed the risk on your original capital. You're playing with house money, so to speak.
Exactly. Your initial principal is protected at break even. Then, and only then, might you consider adding another chunk, say another 1,000 shares at a higher price with its own appropriate stop. You've increased your size, but you did it using paper profits to finance the additional risk, keeping that initial $1,000 of your own capital safe. That's how you compound aggressively when things are working.
That's a perfect segue. Compounding money when things work, not compounding mistakes when they don't. Which brings us to section 4. Know the truth about your trading. This is all about brutal self-honesty and measurement, right?
Absolutely critical. And the source uses that great little story about slot car racing to illustrate it. The champion, Mark, shows up to race against this local legend, Rocky.
And Rocky immediately clocks him as serious. Why?
Because Mark had two things with him, a stopwatch and a notebook. Rocky knew that meant Mark wasn't just driving for fun. He was there to measure, analyze, and improve.
Logging lap times, testing adjustments.
Tires, motor changes, track conditions, everything. Measuring the effect of each variable to find what worked and what didn't. That's the scientific approach to getting better.
And the same applies to trading. Your results are the raw data.
They're your personal truth, your P&L statement, your trade journal. They're like fingerprints of everything you do, good and bad. If you don't measure, if you do the head in the sand thing because you don't want to face the losses.
You're just flying blind.
Worse, you're being lazy and actively preventing yourself from learning and succeeding. You have to track your numbers. The source suggests just the act of knowing you'll have to log a loss can impose discipline. When a stock hits your stop, you think, ugh, how's this going to look on my spreadsheet?
Forces you to follow the rule. So what are the core metrics, the trading triangle?
Yeah, the three essential legs that determine profitability. First, your average win size. Second, your average loss size. Third, your win-loss ratio or batting average.
And if those numbers aren't producing profits?
Well, if your batting average is 50%, but your average loss is 6% and your average gain is only 5%, you're losing money over time. The triangle tells you which lever you need to pull. Make more on your winners, cut your losses smaller, or find a way to win more often. You have to diagnose the problem using the data.
And tracking things like how long you hold winners versus losers can reveal those hidden psychological flaws, right? The stubborn trader indicators.
Oh yeah, those are killers. If your journal shows you consistently hold losing trades for, say, 30 days on average, but you cut your winners after only 10 days.
That's data proving you're letting losers run and cutting winners short. Fear and ego talking, not strategy.
Exactly. The numbers expose those emotional habits that your ego tries to hide. You can't argue with the data. And visually, the goal is that bell curve of returns.
You want it skewed heavily to the right. towards the gains.
Right. Very few, if any, data points to the left of your maximum allowed loss, like -10%. 10%. Lots of trades clustered around smaller losses, and then a big fat tail stretching out to the right, representing your larger wins. That visual reinforces the whole strategy.
This measurement focus also ties into opportunity cost. The idea that turning over capital with smaller, consistent gains might be better than holding out for huge winners.
Yes, time is a critical factor. 6 separate 10% gains compounded actually produce a much higher return, almost double, than one single 40% gain achieved over the same total time frame. Assuming you have that positive expectancy, that edge,
Which your RBA tracking confirms.
then higher turnover, consistently applying that edge, can lead to significantly better overall returns than sitting patiently for home runs, especially if those home runs are infrequent.
Okay, moving to section 5, compound money, not mistakes. And we have to start with what the source calls the absolute deadliest mistake in trading.
Averaging down. Buying more of a stock as its price falls.
Why is it so lethal? It feels intuitive, almost smart. I liked it at $25, now it's $20, it's a bargain.
It's seductive, but it's based on flawed logic. The market is telling you, via the price decline, that your initial decision at $25 was likely wrong. Buying more at $20 isn't getting a bargain. It's doubling down on your mistake. You're compounding your error, not your capital.
The champion quotes Paul Tudor Jones's famous rule.
Losers average losers. Apparently he had that sign right above his desk, a constant reminder. When you average down, you're essentially betting against the market's clear verdict, hoping you know better. It's ego-driven and incredibly dangerous. That's how accounts get wiped out.
And the potential magnitude of declines is often underestimated, the 50-80 rule.
Yeah, that's a sobering guideline from the source. When a stock that's had a massive run finally tops out and starts a major decline, history suggests it's almost certain to fall at least 50% from its peak. And there's roughly a 50-50 chance, like a coin flip, that the fall will eventually reach 80% or even more.
Like the lumber liquidators example, down over 90%.
Exactly. If you just heed that first small loss, that initial 7% or 8% stop, you completely sidestep the possibility of riding it down that catastrophic slide. You avoid the exponential destruction.
But it's hard, especially if the company's story still sounds good or the valuation looks cheap on paper. People fight the tape.
Amateurs, especially, get trapped by the story or the perceived value. Professionals know better, or at least they should. A stock doesn't have to go bankrupt to destroy your portfolio. Look at Cisco after the dot-com bust. Fell 90%, then basically went sideways for 16 years.
16 years of dead money. Massive opportunity cost.
Huge. And then there's the danger of what the source calls differential disclosure.
Explain that.
That's when the public information, the earnings report, the news story looks positive, maybe even great. But the stock price tanks on huge volume anyway.
Like the Crocs example. Beat earnings, stock drops 36%.
Precisely. Your eyes, the price and volume action, are telling you something completely different from what your ears are hearing from the company or analysts. The institutions, the big money, are selling aggressively. They likely know something you don't. That price action is the differential disclosure.
So the rule is, trust your eyes. The tape, not your ears. The story.
Absolutely. The price paid, driven by institutional supply and demand, is the ultimate truth in the market. Ignore it at your peril.
So how do we actively compound money instead of mistakes? It involves scaling exposure correctly.
Yes. You scale up only when things are working. The champion suggests starting small, maybe with just a few positions, a pilot buy approach. Perhaps only 25% of your capital invested initially.
See if the water's warm before diving in.
Exactly. If those initial trades are working, if you're making money, if your process is in sync with the market, then you've earned the right to gradually increase your exposure, add more positions, maybe increase size slightly.
But if those first trades aren't working, if you're losing money being 25% invested,
then the absolute last thing you should do is ramp up to 75% or 100% invested. The market is telling you something's wrong either with your process or the environment. You need to pull back, trade smaller, or even go to cash.
So the rule is, trade your smallest when you're trading your worst, and trade your largest when you're trading your best.
That disciplined approach is key to survival and superperformance. You're only pressing your bets when the odds are clearly in your favor, as proven by your actual recent results.
All right, let's get into the specifics of the strategy itself. Section 6 and 7. How and when to buy stocks. The absolute starting point, non-negotiable according to the source.
Trade with the trend, period. You absolutely must have the wind at your back.
Meaning?
Meaning only buy stocks that are already in confirmed long-term uptrends, stage 2 uptrends specifically. Forget bottom fishing in stocks that have been crushed. Forget trying to catch falling knives. So forget buying stocks that are just drifting sideways in stage 1 or rolling over in stage 3.
Why is stage 2 so critical?
Because that's the phase where institutions are typically accumulating shares, driving the stock higher over time. Buying in any other stage usually leads to dead money, frustration, or outright losses. Paul Tudor Jones had that simple rule, right? Only be long stocks above their 200-day moving average.
Get out if they fall below. Simple, but forces discipline.
That idea is the foundation for the champion's much more detailed trend template. This is a set of 8 specific, non-negotiable criteria. A stock must meet all 8 to even be considered a candidate.
All 8. No exceptions.
Ignoring even one is like a doctor saying, well, the tumor markers look bad, but his cholesterol is great, so let's wait and see. You're ignoring the critical signs. This template is designed to keep you out of fundamentally weak stocks, the serial gappers that just bleed lower.
Okay, let's break down the 8 criteria. The first few focus on moving averages.
Right. Criterion 1. The current stock price must be above both its 150-day and 200-day moving averages. Shows basic long-term strength. Criterion 2. The 150-day moving average must be above the 200-day moving average. Shows that intermediate-term momentum is stronger than long-term, confirming the uptrend's health.
Makes sense.
Criterion 3. The 200-day moving average itself must be trending upwards for at least 1 month, but preferably for 4 to 5 months or more. This is key. Just being above a flat or declining 200-day isn't enough. We want to see that long-term trend clearly established and rising.
So a sustained upward slope in the 200-day proves long-term institutional support.
Exactly. And criterion 4. The 50-day moving average must be above both the 150-day and 200-day moving averages. This lines everything up. Short-term momentum is aligned with and stronger than intermediate and long-term momentum. It's that nice upward cascade of the moving averages.
Got it. 50 above, 150 above 200, and the 200 sloping up. What about the next 4? They seem more related to price location and relative strength.
Yes. Criterion 5. The current price must be at least 20% to 150% above its 52-week low. This filters out stocks that are still near their lows or haven't shown significant recovery power.
Avoids bottom fishing.
Precisely. Criterion 6. The current price must be within 25% of its 52-week high. We want stocks near their highs, showing strength, not stocks struggling far below their peak.
Focus on leadership.
Right. Criterion 7. The relative strength RS ranking should be high. The source uses the IBD RS rating, but the principle is the stock should be significantly outperforming the overall market. Its RS line should ideally be trending up and near its own highs.
Showing it's a leader, not a laggard.
Yes. And finally, criterion 8. The current price must be trading above its 50-day moving average as it emerges from a proper consolidation or base. This is the final confirmation of immediate strength just before or at the potential breakout point.
Wow, okay. That's a rigorous checklist. Sticking to that really forces you to focus only on the strongest stocks and established uptrends. It prevents chasing junk like Valent that Ackman famously bought more of while it was failing most of these rules.
Exactly. It's a quality filter. Once a stock passes the trend template, then you look for the specific entry pattern. And the key pattern is the Volatility Contraction Pattern, or VCP.
VCP. Explain what that looks like and why it's important.
VCP is all about identifying periods where a stock, after advancing, pauses and digests its gains in an orderly way. The defining feature is volatility shrinking or contracting from the left side of the pattern to the right side.
So wider price swings initially, then progressively tighter swings.
Exactly. It looks like a spring, coiling tighter and tighter. You might see a pullback of, say, 15%, then a smaller rally and pullback of maybe 8%, then an even smaller one of just 4%. That tightening action is crucial.
And what's happening under the surface during that contraction? Supply and demand dynamics.
That's the key. As the price range tightens, especially with tight daily and weekly closes near the highs of the range, you absolutely must see volume drying up significantly, often well below the 50-day average volume.
Why is low volume so important there?
It signals that the sellers are disappearing. Supply is being exhausted. The only sellers left are holding out for higher prices. This means the stock is now poised to move up sharply on even a small increase in demand because there's very little overhead supply left to absorb.
The path of least resistance is now upwards.
That's the concept. The VCP identifies that point. The source uses a shorthand technical footprint to describe these patterns quickly, like that MELI example, 6W326 3T.
Right. Break that down. What does 6W3263T tell you about Mercado Libre's base?
Okay, 6W means the entire consolidation pattern took 6 weeks to form. 326 represents the volatility contraction. The deepest pullback within that 6-week base was 32% off the high, but the final, tightest contraction just before the breakout was only 6% deep. Huge shrinkage in volatility.
From wild to super tight.
Exactly. And 3T just means there were 3 distinct tightenings or waves within that base, the 32%, the intermediate one, and the final 6%. This shorthand gives you a quick objective picture of the base's structure and quality. The buy point, the pivot, occurs as it breaks out above the high of that final tight 6% contraction.
Okay, so we've got the trend template for identifying what to buy and the VCP for when to buy. Now, for Section 7, some final nuances on selection and identifying really explosive moves. This again tackles that urge to buy stocks that look cheap because they've fallen a lot.
Yeah, it reinforces the point. Focus exclusively on stocks that correct the least during market pullbacks or while forming their bases. Most constructive VCPs form after corrections of maybe 10% to 35% off the prior high. If a stock has corrected 60%, 70%, 80%,
GoPro in the example,
it should just be off your list, period. A stock down that much is demonstrating massive relative weakness, and it has a mountain of overhead supply, all those trapped buyers just waiting to sell if it rallies back even a little. It makes upside progress incredibly difficult.
So again, fight the instinct to buy something because it's down a lot. Strength begets strength.
And superperformance, those truly life-changing gains, requires stocks to make a series of new highs over time. You cannot be afraid to buy stocks making new highs, especially if they're emerging from a tight VCP base near those highs and the relative strength line is confirming the leadership.
Like Amazon or Monster Beverage, thousands of percent gained by constantly hitting new highs.
Their charts are just a staircase upwards. Your job is to find those low-risk entry points, those VCPs, along the way. And a huge tip-off is when the RS line breaks out to new highs before the stock price itself breaks out.
What did that tell you?
It suggests smart institutional money is moving in quietly, recognizing the strength before the crowd does. That's a very bullish sign.
Now, besides the standard VCP, the source highlights some particularly powerful high-velocity patterns, like the power play or high-tight flag.
Ah, the power play. Yes, these are rare but incredibly potent. They can lead to explosive gains very quickly.
What defines a power play? What are the criteria?
It requires, first, a truly massive near-vertical price surge, often 100% or more in just 8 weeks or less. Huge move, usually on enormous volume. This signals something fundamentally game-changing is happening with the company.
Okay, huge rapid advance. Then what?
Then it pauses and consolidates sideways very tightly. Critically, this consolidation should not correct more than 20%, maybe 25% absolute max from the peak of that rapid run, and it usually lasts for about 3 to 6 weeks.
So explosive move up, then a tight sideways digestion, not giving back much ground.
Right. That tightness after such a huge run shows immense underlying strength. Buyers are absorbing any selling very quickly. The source notes these patterns are so powerful, you might even buy them before the fundamental reason becomes obvious because the price action is just screaming that something big is afoot.
Another powerful pattern mentioned is the 3C cup completion cheat.
Yeah, the 3C. It's a variation on the classic cup with handle pattern, often appearing earlier in a stock's run. It involves a sharp initial rally, then a rounding consolidation phase forming the cup, and then, importantly, a final small pause or pullback within the upper part of that cup, often near the old high. That little pause is the cheat area.
Why is it called a cheat?
Because it offers a slightly earlier, lower risk entry point than waiting for the stock to break out over the absolute high of the entire cup pattern. It often drifts down slightly, shaking at impatient holders, volume dries up, and then it turns and breaks above the high of that little cheat area. JetBlue and Cirrus Logic had great examples.
So if you've done your homework, you have the trend template screen, you've identified several stocks setting up in VCPs or maybe even these power patterns. How do you decide which ones to actually buy, especially if capital is limited?
You prioritize. You buy in order of strength. Which stocks are breaking out first? Which ones are showing the most powerful volume signatures on the breakout? Which ones have the highest relative strength?
Let the market tell you which are the true leaders right now.
Exactly. Don't play favorites based on the company story or because you like their product. Put your money into the stocks the market is most aggressively validating today. That's how you latch on to the real leaders early.
And this approach helps you capitalize during those strong market phases, like a lockout rally.
Yes. A lockout rally happens often early in a new bull market, where the market just grinds higher day after day. Amateurs keep waiting for a decent pullback to buy, but it never comes because institutional demand is just too strong.
They get locked out.
Right. The market ignores overbought signals. If you see the major indexes acting strong, pushing higher even when they look extended, and your list of leading stocks setting up correctly is expanding, that's a huge green light. That's the time to be aggressive, get invested, follow the litters breaking out because the market is in a powerful uptrend.
Wow. Okay. So let's try and wrap this all up. We've covered a massive amount of ground here, really the entire blueprint from the inside out. What does it all mean?
Well, we started with the mindset, right? Choosing to be the disciplined builder, not the impulsive wrecking ball, taking that 100% responsibility.
And the absolute necessity of planning. Contingencies for everything. Understanding if your trade is a tennis ball or an egg.
Followed by the iron laws of risk control. Risk-first thinking, never risking more than your RBA, your actual results, says you can afford. That hard 10% max loss, but aiming for much less.
Then the brutal honesty of self-analysis. Tracking your stats, the trading triangle, understanding your psychological flaws, and absolutely no averaging down on losers. Compound money, not mistakes.
And finally, the specific how-to. Using the trend template to find the right stocks in stage 2 uptrends, and timing entries with the VCP and those high-velocity patterns like the power play or 3C.
The common thread through all of it seems to be discipline, consistency.
That really is the core difference, isn't it? Between the amateur who gets lucky sometimes and the professional who produces consistent results over years. It's not about being a genius predictor. It's about the relentless, consistent application of a set of rules that give you a positive mathematical edge, that positive expectancy over the long haul.
And protecting that edge means rock-solid defense. You just can't win big if you're constantly giving back huge chunks to the market through sloppy risk management.
It decimates your capital and your confidence. This whole blueprint really is about building both simultaneously through rigor, through humility, through trading based on proven results, not just hope or guesswork.
Yeah, that RBA concept really forces you to trade the reality of your own performance.
Which leads us to maybe one final kind of provocative thought from the material. It touches on adjusting your approach based on how well you're doing, but maybe in a counterintuitive way.
Oh, how so?
The champion notes that when trading is going poorly, when the market's tough and your win rate drops, that's when you need to be most defensive. Tighten those stops even further, take profits much quicker, trade smaller size.
Okay, that makes sense. Protect yourself when things are bad.
But conversely, when things are going well, when your trades are working, your win rate is high, you're building profits, that's actually the time to become a bit more forgiving. Maybe give stocks a little more room, use slightly wider trailing stops, press your bets, trade larger size.
Wait, that feels backwards. Shouldn't you be more cautious when you're winning to protect those profits? And more aggressive when you're down, trying to get back to even?
That's the typical amateur instinct. But think about it. When the market is difficult and your strategy isn't working, being aggressive just digs the hole deeper. Tightening up forces you to minimize damage, trade small, maybe even sit out. It preserves capital and confidence. But when your trades are working consistently, it means your process is aligned with the current market environment. Your edge is sharp. Your recent profits effectively pay for the risk of being more aggressive. You've earned the right, through demonstrated success, to press your advantage.
So be aggressive when you're right and defensive when you're wrong or unsure, not the other way around.
Exactly. That dynamic adjustment, maximum aggression only when results validate your edge, maximum defense when they don't, is crucial for achieving those super performance returns while keeping drawdowns survivable. You compound capital when the wind's at your back, and you protect it fiercely when you're sailing into a storm.
You have to earn the right to take bigger risks by proving your edge first. That really ties it all together. Fantastic insights. Thanks so much for walking us through this blueprint.
My pleasure. Hopefully it gives everyone listening some powerful tools to, to feed that inner builder and start respecting that risk every single day.
Absolutely. We'll catch you next time on The Deep Dive.
Welcome to The Deep Dive. Today, we're really digging into what separates the super performers, the truly world-class traders, from, well, everyone else. And we're moving way beyond just picking the right stock. That's only part of the picture. Our mission today is to dissect the absolute non-negotiables, how you size your positions, when you actually take your profits, mastering that exit, and crucially, building that bulletproof mindset of a champion trader.
It's exactly right. So critical. If you're focused on getting those really big returns, those outsized gains, but you also want to keep your risk under control, this is the blueprint. We're stepping past just the mechanics of a strategy, the entry signals, and diving deep into the disciplines that actually protect your capital and let compounding work its magic. The goal here is really to give you the framework and, just as importantly, the mindset you need to actually use this knowledge effectively. And that starts with the absolute foundation, managing risk.
Okay, let's unpack that, starting with position sizing. You always hear that old advice, don't put all your eggs in one basket. But the research we looked at suggests superperformance actually needs a very calculated balance. It's somewhere between spreading yourself too thin. They actually call it diversification, which I kind of like.
Yeah, dilutes everything.
Right. And the other extreme, over-concentration, where you face that catastrophic risk of ruin. So what's the ironclad rule here for defense?
The absolute bedrock, the essential defense mechanism is rigid control over how much of your total equity you expose on any single trade.
Oh.
You should never, and I mean never, risk more than, say, 1.25% to 2.5% of your total account value on one idea.
Hang on, 1.25% to 2.5%, that sounds, incredibly small. If I'm being that conservative, how on earth do I generate those big returns we're talking about? Isn't that kind of diversification meant to, smooth things out?
It seems small, but it's small for a very specific mathematical reason, that traditional diversification. It often just dilutes your edge, the very thing giving you potential for outperformance. See, if you risk more than that 2.5% maximum, you open yourself up to geometric losses. Those are the kinds that become almost mathematically impossible to climb back from. Just think about it. A 50% loss in your account requires a 100% gain just to get back to where you started. It's brutal. So by capping your risk per trade, you force yourself to take smaller, manageable losses when you're wrong. And those losses, on average, should be around 5 or 6%, maybe 7%. Never, ever let a stock loss exceed 10% against your entry.
Okay, I see. So the small percentage risk protects the overall capital, the principal, which then allows the winners to compound effectively without being wiped out by one bad trade. So how do you actually calculate your position size then to make sure you stay inside that 1.25% to 2.5% equity risk window?
Yeah, you have to work backwards. You sort of back into the risk. Let's use a simple example.
Sure.
Say you have a $100,000 account. If you decide your absolute maximum equity risk per trade is 2.5%, well, that's $2,500. $100,000 times 0.025. That's the most you can lose on that single trade, period. Now, let's say you've determined your stop loss on the stock itself needs to be 10% below your entry price. To keep your total dollar loss under $2,500, your position size can't be more than $25,000. See, $25,000 times a 10% loss is $2,500. So in that $100 K account, that's a 25% position size. If you want to be more conservative, maybe risk only 1.25% of your equity, $1,250. You'd either have to cut your position size in half to $12,500, or you'd need to find a trade with a tighter stop, maybe 5%. The key is that the position size and the stop loss percentage, they have to be adjusted together. They dance together to make sure you always honor that core equity risk guideline.
Okay, that makes the math really clear. It's non-negotiable. So once you've got the risk math sorted, what does optimal concentration actually look like? If diversification is the enemy, how many stocks should you ideally hold?
Yeah, good question. The sweet spot, based on studying superperformers, seems to be concentrating your capital pretty heavily into the absolute best names you can find. Typically, that means holding maybe 4 to 8 stocks total. Ideally, you're putting 20% to 25% of your portfolio into each of your top 4 or 5 ideas. Once you start holding more than, say, 10 or 12 stocks, you inevitably dilute the impact of your best picks. You're just spreading your limited capital too thin.
I really liked the garden analogy that came up in the research we looked at. It kind of flips the usual way people think about managing their holdings. Instead of agonizing over the stocks that aren't working.
Exactly. You treat them like weeds. And what do you do with weeds in a garden? You pull them. You have to be constantly evaluating your holdings. If some stocks are just sitting there, not performing, being mediocre, those are your weeds. And then you apply what's called the 2-for-1 rule to reallocate that capital. You might sell half of your position in 2 of those underperforming weeds to free up enough cash to fund a full new position in a much more promising candidate, one of your flowers that's really showing strength. Your money should always be flowing towards where it has the highest potential for growth. Water the flowers, pull the weeds.
Okay, so that covers the defense, limiting the downside. Let's pivot now to maybe the hardest part for almost any trader, Knowing when to sell a winner, it's such an emotional battleground, isn't it? That fear of missing out on even more profit versus the regret of watching your gains evaporate.
Oh, absolutely. It's pure emotional conflict. And that's precisely why you need rules. Rules are the only way to kind of neutralize that internal battle. Look, the professionals, the smart money, they generally aim to sell into strength, while the stock is still advancing strongly. Amateurs tend to hold on too long, driven by hope or greed, and then they're forced to sell into weakness when things turn ugly. You have to learn to use objective signals, things you can see on the chart or in the numbers, to gauge where a stock is in its life cycle.
Right. So what are some of the most reliable objective signals that we should be looking for?
Well, one key technique is called base counting. Think of a stock's big price move starting from a consolidation period, or a base. The first couple of bases, base 1 and base 2, they happen early in the stock's overall advance. These usually offer the biggest potential for a long, sustained run. But once a stock is breaking out from its 5th or 6th base, that's a huge red flag. It signals a very late-stage move.
Okay. And why are those late-stage bases, the 5th or 6th ones, why are they considered so prone to failure?
Well, think about it. By the time a stock has formed that many bases and run up significantly, pretty much every investor, every amateur has heard the story. The stock's been talked about everywhere. There often aren't many new buyers left to fuel the move higher. It's mostly existing holders who are now looking for the exit door. So you combine that late-stage base count with something like PE expansion. That's when the stock's price is accelerated way faster than its actual earnings growth. That's a major warning sign. It suggests speculation is getting extreme. Then you start looking for the specific chart signals that often scream climax top or blow off top.
And what does that climax top actually look like on a price chart? What are the tells?
You're looking for really accelerated, almost frantic action, like maybe 70% or more of the trading days in the last week or two are up days, very little selling pressure. And crucially, you often see the single largest up day or the largest daily price range, the spread from high to low, occurring right near the end of the move. It's like the final burst of euphoria.
Yep.
And also look for recent exhaustion gaps.
Okay, exhaustion gaps. For listeners maybe not familiar with that term, what exactly is an exhaustion gap and why is it a sell signal?
Right, an exhaustion gap is when the stock price gaps up significantly at the open, usually on very high volume, often pushing far above its recent trend line. It looks powerful, but it actually signals the last desperate gasp of buying enthusiasm. It suggests the market is literally exhausted. There are no more buyers willing to chase it at those elevated prices. I mean, think about that classic Amazon.com story from back in the day. It rocketed up something like 97% in just 6 trading days, and then promptly collapsed 95% in the bear market that followed. That one example shows you just can't afford to let hope or emotion dictate your selling decisions.
Wow. Okay, so that's selling into strength. But what if you miss that? What are the signs that tell you, okay, now I have to sell, even though it's starting to fall, selling into weakness?
Selling into weakness usually means the big institutional money is heading for the exits. You'll see a major price reversal, maybe a sharp drop after making a new high, and it will be on overwhelming, significantly heavy volume, much higher volume than usual. And this can happen even on what seems like good news. Sometimes a company reports great earnings, but the stock tanks on huge volume. We sometimes call that differential disclosure. The institutions knew something or interpreted the news negatively before the public did. The key is, you absolutely cannot confuse a sharp break on massive volume with a buying opportunity, a bargain. You have to respect the price and volume action above all else, even the news headlines.
Got it. So to try and lock in some gains before you get to that painful point, the research mentioned the concept of the free roll. Can you explain that, maybe using that R multiple language, the risk multiple?
Yes, the free roll is absolutely essential. It's about protecting your capital, but also protecting your confidence. It works like this. First, you define R as your initial risk on the trade. Let's say you risked $100 per share or $1,000 total on the position that's your 1R. Once the stock moves up enough so that your profit is 2 or 3 times that initial risk amount, so you have a $200 or $300 per share profit, a 2R or 3R gain, you immediately sell half of your position. Then critically, you move the stop loss on the remaining half up to at least your original entry price, your break-even point.
Ah, okay. So using your example, risked $100, 1R, now up $300, 3R. Sell half, bank that $150 profit per share or $1 FIFAR, then move the stop on the other half to break even. So the worst case scenario now is you make money on the first half and scratch the second half. You can't lose overall.
Exactly. Your principal on that trade is now totally protected. You've locked in a profit, it takes the stress off, and you just have to accept the reality. You will always sell too soon or too late. Nobody perfectly nails the top or bottom consistently. The goal isn't perfection, it's consistently capturing a good chunk of the move, protecting your capital, and minimizing regret. Aim for decent profits, consistently.
Okay, so we have position sizing for defense and rules for selling to lock in gains. Let's zoom out a bit now and look at the overarching philosophy that connects all this. The research outlines 8 keys to unlocking superperformance, defined as achieving those big returns with low risk. Let's tackle the first 4 keys, the ones focused on generating the big performance.
Right. First key, timing. You absolutely have to use chart patterns, specifically things like the VCP or Volatility Contraction Pattern, to find what are called velocity trades.
Okay, VCP, Volatility Contraction Pattern. Just briefly, for listeners maybe not familiar, why is that VCP pattern so key for finding that velocity?
Because the VCP identifies a stock that's gone through a necessary quiet period, a consolidation, where the price swings get tighter and tighter, the volatility shrinks right down. Like the stock is coiling up, building energy like a spring. When it breaks out from that tight pattern, it's often poised for a really explosive move, those 20%, 30%, even 50% gains in just a few weeks or months. That's how you compound capital rapidly. Okay, second key, don't diversify. We've touched on this, but it bears repeating. Forget spreading your money thinly. Concentrate your capital in your best 4 to maybe 12 ideas, max.
The third key really flies in the face of a lot of conventional investing wisdom. It's turnover is not taboo. People are always worried about trading costs, taxes.
Look, if you genuinely have an edge, if your system works, then frequent buying and selling turnover is actually what maximizes the compounding effect. You move capital from mediocre situations to high potential ones quickly. You should never, ever make a sell decision based purely on avoiding taxes or minimizing turnover. Your goal is the capital gain. Worry about paying the taxes on that gain later. And the fourth key for performance, always maintain a favorable risk-reward ratio. Before you even enter a trade, you should realistically expect the potential gain to be significantly larger than your potential loss. Like risking maybe 7% for an expected gain of 15% or 20% or more. Always stack the odds in your favor.
Okay, those are the performance drivers. Now let's hit the other 4 keys, the crucial ones for limiting those drawdowns, the ones that protect the capital you've just worked so hard to compound.
Right, the defense. First, sell into strength. We talked about this. It's almost always better to sell a bit too early than way too late. Don't get greedy. Second, scale your exposure up and down. This means you trade your largest position sizes when your strategy is working well, when you're making money. Let your profits finance increased risk. But the moment things start going wrong, when you hit a string of losses, you must trade smaller. Cut your size way down. If you find yourself trading poorly, making mistakes, you have to slow down, reduce size, or even just take a break altogether. Stop digging the hole deeper.
That makes sense. Scaling down when losing isn't just about preserving capital, it's also psychological, right?
Yeah.
It forces a pause, breaks that cycle of maybe emotional revenge trading.
Exactly right. It forces discipline. Okay, third key for limiting drawdowns. Always trade directionally. This means don't fight the primary trend of the stock or the market. Don't try to short stocks in a roaring bull market or buy stocks collapsing in a bear market. Don't try to catch falling knives. Buy strength, sell weakness, go with the flow, a path of least resistance. And the fourth key for defense, protect your break-even point. As soon as you have a decent gain on a trade, maybe 1R or 2R, immediately move your stop loss up to your entry price. Protect your principal. Turn that trade into essentially a guaranteed free roll we talked about earlier.
Okay, this brings us perfectly to what might be the most critical piece of the entire puzzle. The psychological component, the champion trader mindset. All these rules, all these keys, they're kind of worthless if you don't have the mental discipline to actually follow them, right? The research is really clear. Fear is the absolute #1 killer emotion for traders. It causes constant self-sabotage.
It absolutely is. And the goal, the ultimate state you're striving for, is achieving a sense of detachment from the outcome of any single trade. You need to be able to execute your plan, your rules, with complete certainty, almost like a robot, whether that specific trade ends up being a winner or a loser. And the way you build that detachment is through consistent mental rehearsal. You literally need to practice 2 scenarios in your mind, over and over every day. First, visualize yourself following your plan flawlessly, identifying the setup, entering correctly, setting your stop, managing the trade according to your rules. Second, and just as important, mentally rehearse taking that small planned loss when your stop gets hit. Visualize yourself accepting it immediately, without anger or frustration, shaking it off like Muhammad Ali taking a punch in the ring and just staying focused on the fight. You immediately move on to the next opportunity.
So it's about shifting the entire focus away from the money, the P&L, the outcome,
Yes, shift from outcome to process.
and focusing entirely on executing the process correctly.
Exactly. The money is just the natural result, the byproduct of consistently executing a well-thought-out, statistically sound plan. You should really build daily preparation rituals around this. Every morning or every evening, reviewing the day. What went well? What did I execute perfectly according to my rules? Then identify maybe 2 or 3 specific lessons learned from any mistakes. And crucially, ask yourself, okay, how am I going to improve specifically on that tomorrow? And write these things down. It turns every trade, win or lose, into a learning experience, positive reinforcement.
That leads right into the challenge of breaking bad habits. If a trader keeps making the same mistakes, chasing stocks, holding losers too long, violating the risk rules, what's the hidden internal reward they might be getting from that bad behavior? Because there usually is one, right?
Oh, absolutely. There's always a hidden payoff, even for destructive behavior. Maybe they get an unconscious psychological reward, like an adrenaline rush from the excitement and danger of taking big risks. Or perhaps they get a strange sort of validation from being able to tell war stories about their dramatic losses. It gets them attention. To break these deep-seated habits, you have to consciously reprogram your brain's pain-pleasure cycle. You use cognitive conditioning.
Okay, reprogramming the pain-pleasure cycle.
Yeah.
How do you actually do that in practice, especially in a high-stress environment like trading?
You have to actively, consciously train your body and mind to associate following your rules, even when it leads to a small loss, with intense pleasure. It sounds counterintuitive, I know. So when you follow your rules perfectly, you identify the setup, you enter, you set your stop, and then the stock ticks down and stops you out for that small planned loss, which normally feels painful, right? In that exact moment, you must celebrate. Seriously. Jump up from your chair. Play your favorite pump-up song really loud. Do a little dance around your office. Fist pump. You have to create an immediate, strong, positive physical and emotional sensation linked directly to the act of cutting that loss quickly according to your rules. What this does over time is it trains your nervous system to feel that taking the disciplined small loss is actually a huge victory. It replaces the old pattern of associating rule following and small losses with pain, and replaces it with the immediate reward of feeling disciplined, in control, and victorious. And this really highlights the difference between just dabbling in trading versus committing to mastery. Dabblers tend to quit when things get tough, when they hit a learning plateau. They see it as proof they can't do it. Masters, on the other hand, they see those same plateaus not as roadblocks, but as essential opportunities to refine their skills, to deepen their understanding, to hone their expertise. They commit to staying the course, doing the reps, even when it's not easy or exciting.
Wow. That's such a powerful way to frame it. What a deep dive this has been. I mean, the ultimate takeaway seems to be that trading success isn't really about getting lucky or having some innate genius talent or finding some secret indicator. It really is a choice. A choice built on unwavering discipline, rigorous risk management that protects your capital base, and maybe most importantly, training your own mind to focus relentlessly on executing your process, not obsessing over the immediate outcome of any single trade.
That's it, precisely. And maybe here's a final thought for everyone listening to really mull over. Your potential, your actual ability to achieve success in this field is probably far, far greater than even your wildest imagination currently allows. But, and this is the crucial part, unlocking that potential requires you to take absolute 100% responsibility for every single one of your results. No excuses. Because until you truly accept, deep down, that winning is a choice driven by discipline and process, you simply won't realize your full capacity.